China's solar industry is teetering on the edge of transformation, caught between the chaos of overcapacity and the promise of sustainable recovery. For years, this sector has epitomized both the triumphs and pitfalls of rapid industrialization. Booming growth, followed by fierce price wars and an unsustainable race to expand at all costs. But now, in 2025, a new chapter is unfolding. The Chinese government is stepping in with bold measures to reshape the industry, combining regulatory intervention, self-regulation, and financial restructuring. The critical question remains, can these steps truly lead to a lasting recovery, or will the industry continue to be bogged down by its own excesses? And this is the part most people miss. What happens next could redefine not just China's solar landscape, but global energy markets as well. Policy-driven restructuring, a new era of accountability. At the heart of this transformation is the Ministry of Industry and Information Technology, MIIT, which taken decisive action. High-profile meetings with industry leaders like Longi, Tongwei, and GCL have sent a clear message. It's time to prioritize quality over quantity, rein in reckless competition, and phase out outdated production methods. One of the most significant initiatives involves a 50 billion yuan, $7 billion, fund spearheaded by Polysilicon producers. This fund aims to acquire and shutter one-third of low-quality production capacity, a strategy reminiscent of past efforts in industries like steel. By trimming excess supply, the goal is to stabilize prices and restore profitability. But here's where it gets controversial. The government's approach isn't just about top-down mandates. The China Photovoltaic Industry Association, CPIA, is urging companies to stop undercutting each other by selling below cost and to align production with real-world demand. Local governments, once eager to fuel growth through subsidies and tax breaks, are now under pressure to tighten oversight of investments. This marks a dramatic shift from the growth at all costs mentality that drove the sector's boom and bust cycles. However, will they follow through, or will economic pressures cause them to backtrack? Financial implications, short-term pain for long-term gain. The financial fallout from overcapacity has been staggering. In 2024 alone, Chinese solar firms racked up $40 billion in losses across the manufacturing value chain. Utilization rates in key segments like polysilicon and modules hovered around 50%, a grim indicator of inefficiency. To put this into perspective, the top 10 module manufacturers shipped a record-breaking 500 gigawatts of modules last year, but collectively posted $4 billion in losses. Yet there are glimmers of hope. Polysilicon prices, which had been in a nosedive for nearly 2 years, rebounded by 22% in mid-2025 thanks to government intervention. Glass manufacturers such as Xinyi Solar and Flat Glass announced plans to cut production by 30% to ease oversupply, while polysilicon producers explored mergers to consolidate operations. These moves suggest the industry is finally confronting its overcapacity issues, but the road to recovery is still long and uncertain. Technology as a game changer. The rise of N-type modules. Amid the turmoil, technological innovation is emerging as a beacon of progress. N-type modules, including advanced technologies like TLP-CON and HJT, are gaining traction due to their superior efficiency and ability to command higher prices. For instance, Jinko Solar reported that 87% of its 2024 output was in N-type formats. This pivot is crucial because as global demand for high-efficiency solar solutions rises, Chinese companies leading in this space could reclaim market share and profit margins lost during years of destructive price wars. Downstream players in the inverter and variable frequency drive (VFD) sectors are also capitalizing on this shift. Companies like Sungrow and Huawei are integrating AI and vertical integration to enhance performance and reliability. Sungrow's 2024 revenue of 77.86 billion yuan highlights the potential of this segment, while Huawei's AI-powered inverters showcase the cutting-edge advancements driving the industry forward. Investment opportunities: who stands out and why? For investors, navigating this complex landscape requires a keen eye for resilience, innovation, and strategic positioning. The Sinovoltaics 2025 manufacturer ranking reports spotlight firms like AP Systems, Synexcel, and Eaton, which boast Altman Z-scores above 2.6, a strong indicator of financial stability. Industrial giants like Delta Electronics and ABB are also noteworthy for their expertise and global reach. Downstream companies, particularly those in the inverter and VFD sectors, present an attractive opportunity. These businesses are less vulnerable to upstream overcapacity and are benefiting from growing demand for high-efficiency systems. For example, Longi Green Energy plans to upgrade 40% of its production lines to boost efficiency, positioning itself to thrive in a post-restructuring environment. Similarly, Jinko Solar's ambitious 2025 shipment targets, 85 to 100 gigawatts, reflect confidence in its ability to navigate the transition successfully. Risks and realities, challenges that can't be ignored. Despite these promising developments, significant hurdles remain. Overcapacity in polysilicon and wafers continues to plague the industry, with production capacity still exceeding demand by threefold. Efforts to enforce pricing floors and consolidate capacity have been inconsistent, and local governments may resist reductions due to concerns about employment and economic impact. On the global stage, trade tensions add another layer of complexity. Tariffs imposed by the US and EU, combined with Europe's ambitions to build its own solar supply chain, are pushing Chinese manufacturers to explore new markets in regions like the Middle East, Africa, and Southeast Asia. While this diversification could help alleviate domestic oversupply, it introduces fresh risks, including geopolitical instability and unfamiliar regulatory environments. Conclusion: a sector poised for change. China's solar industry stands at a crossroads, grappling with the consequences of its past excesses while striving for a more sustainable future. The government's anti-overcapacity measures, though imperfect, demonstrate a commitment to structural reform. For investors, the path to success lies in supporting companies that can adapt to this evolving landscape, those with robust balance sheets, innovative technologies, and a global mindset. The journey ahead won't be easy. It will require patience, foresight, and a willingness to embrace uncertainty. But for those who can see beyond the immediate challenges, the rewards could be transformative. As the industry transitions from a cycle of involution to one of evolution, the ultimate winners will be those who don't just survive, but thrive.